Selçuk Armağan is searching for a job. He used to be a construction worker but was made redundant when the economy began slowing last year.
The abrupt rise in the US dollar was felt in the sector within a week, and the companies started to take preventative measures. The first step was, of course, layoffs.
The Turkish lira fell sharply against the US dollar in 2018, partially due to deteriorating ties between Ankara and Washington. That sent prices spiraling, forcing the central bank to hike interest rates to keep foreign investors from pulling out of the economy. Higher borrowing costs have helped reduce inflation from more than 20% in January to about 15% in June. But they've hurt local businesses, which have had to pay higher rates for loans. Now that prices aren't rising so quickly, the central bank slashed borrowing costs to 19.75%. That's a bigger drop than many analysts expected, but is in line with President Recep Tayyip Erdogan's mandate. He believes lower interest rates will boost the economy and create more jobs.
We are leaving the dire straits of unemployment behind us. God willing, we will not only compensate the losses, but we will create even more jobs in a very short time.
Some economists fear such a sharp drop in interest rates could leave the central bank vulnerable if Washington pressures Ankara over its purchase of the Russian S-400 missile defense system. But US President Donald Trump says that's not likely.
The previous administration made some very big mistakes with regard to Turkey, and it was too bad. So we're looking at it. We'll see what we do. We haven't announced that yet.
Borrowing costs are also expected to fall in the US and the EU, making emerging markets like Turkey more lucrative for foreign investors seeking higher returns. And with the central bank looking to stimulate growth, people like Selçuk Armağan may soon be back on the job. Mobin Nasir, TRT World.
Let's get more on this now with Hakan Akbas, who joins us from Bodrum in Turkey. He's a senior advisor at Albright Stonebridge Group, a global strategic advisory and commercial diplomacy firm. Welcome back to Money Talks, Hakan. Now, a 4.25 percentage point cut to Turkey's benchmark interest rate. Are you surprised by the scale of this interest rate cut?
Hi, Oscar. Great to be with you again. It was definitely the right move at the right time. And actually, I called it with 400 basis points. And as you know, the expectation was ranging from 250 to 300 basis points. So the central bank actually, with the new leadership, came up with a front-loaded reduction to actually get ahead of the market expectations, which will certainly help going forward. And as you remember, a year's time, they hiked the rates by 625. Now we gave back 425 of it. So the fact that we are below the psychological threshold of 20% actually is also very helpful. So as you were announcing earlier, the Fed is expected to cut rates next week. And there was pretty dovish comments from ECB earlier. And also emerging markets such as South Africa, South Korea, and Ukraine also cut rates. So right now, even with this rather big rate cut, Turkey is still offering around 4.75% real interest rate, which is the highest in emerging markets. So we have mostly more room to cut the rates going forward.
As we heard, the central bank cited improving economic conditions in Turkey as the reason why it made this interest rate cut. What conditions are they talking about?
Certainly, inflation, as you pointed out, has been improving, and the bank is forecasting below 15% inflation by the year end, and stability in Turkish lira in the last 3 months obviously helped a great deal. Also, current account deficit has disappeared. So going forward, obviously, and also the lower geopolitical risks vis-a-vis US and EU also has helped. So we have the right market conditions right now to further take the rates down.
Now, we know the Turkish President Recep Tayyip Erdogan is a fan of lower interest rates to boost growth, but also to ease inflation. How do lower borrowing costs achieve that?
President Erdogan, as you pointed out, would like single-digit inflation rates and single-digit interest rates. And obviously, to be able to achieve that, lower rates will bring lower borrowing costs. But we need these lower borrowing costs to be able to stimulate the growth so that the consumers will be spending more. But more importantly, small to medium-sized businesses or bigger corporations will be investing with lower borrowing costs to create employment. This is what we need, and even the change in the central banks sort of notes saying that they will be using all the instruments in pursuit of the price stability and financial stability. Actually needs to be noted because it's not about just containing inflation, but also stimulating growth going forward.
Okay, Hakan Akbas, we'll have to leave it there, but thank you for your analysis as always.